Hi, my name is Michael J. Lehrhaupt, and I am President and CEO of Strategies for Retirement.
And I'm Laura Lehrhaupt, and I'm Vice President of Strategies for Retirement.
Strategies for Retirement, our main mission has always been to help our clients protect their assets and income due to financial risks that they'll face in the future.
And when they work with us, they get a peace of mind, a stress-free retirement for their future, which gives them the ability to do all the things they love and make all their dreams come true.
So I've had the privilege of being in this business now for close to 30 years. And here in Connecticut, we've been in Connecticut 20 of those years, and we've really grown a very successful agency servicing our clients and helping them with their financial needs. Now, throughout that time, I've had the pleasure of and the honor of being quoted in the New York Times and the Wall Street Journal. I've appeared on TV several times, actually on national radio. I've been able to travel the country, actually doing a lot of training in our industry. And we've won several awards. One's called the 5-Star Wealth Manager Award. It's the 5th year in a row that we've had the honor of winning that award. You could see that in Connecticut Magazine every December. And we actually have a radio show here in Connecticut too on AM radio. And we talk about different financial strategies every Saturday morning on AM radio here in Connecticut.
So I believe what sets Strategies for Retirement apart from other companies is that we really take pride in our customer service. We treat our clients as if they were family because actually they really are our family. We give them the best treatment. We always get to whatever they need. We never keep them hanging. And nowadays that's kind of rare. So I'm really proud of our team here. We've built a wonderful team over the last 20 years of really dedicated people who serve our clients so well. And I can't tell you how many times clients really appreciate that.
Welcome everyone to our webinar today. We're going to talk about annuities, fact or fiction, right? Are annuities good or bad? There's a lot of information about annuities out there, and we're going to cover it. I'm going to give you really some great information today about a word that's completely misunderstood, and that word is annuities. A little hint here, there are many different kinds of annuities, right? So we're going to go over this because I think you're going to find today's webinar fascinating as far as the history of annuities and what they're used for. With that said, my name is Michael Lehrhaupt, President and CEO of Strategies for Retirement. I'm glad you could join me as well as our team here to join us for our webinar. If you're new to us, welcome, glad to have you. If you have seen our other webinars, educational webinars before, welcome back. Love to see you. With that said, if you're new to webinars, make sure your volume is turned up and make sure you have a pen and paper. I'm going to cover a lot of important things that you're going to want to take notes on. Also, if you get disconnected, there's a reconnect button at the top of this page. And one last thing that's really important is there's many different areas to this webinar. It's a little bit interactive. So you're on the right-hand side, you're going to see a tab. A red tab with 3 little dots. Now, if you click that red tab with 3 little dots, it's going to open up a whole new world on this webinar for you. One is called a chat box. And the chat box is really important to go to because that is your way of asking us any questions that you have. I can't see you, but I can see what you put in the chat. And I'd love to get all your questions answered today. Say hello. So find the chat right now and say hello in the chat. I see a bunch of people here, Pasquale, Heather, Laura, Mira, Jim. So welcome. As you come in, say hello to me on that chat. I'd love to see some questions today as well. I'll try to answer as many as I can. But with that said too, as I go over this, pay attention to that red tab with 3 little dots because there's other areas in that as well. That I'm going to go over and have you click while I go over the material. So I'm not going to waste any time. Today's webinar is short and sweet. All right, we're going to spend maybe a half an hour on this, but I think it's really important, very important information. So let me get to my slides here. And this is a brand new webinar we're doing. This is a new one. If you've seen our other ones, this is a little bit different, right? We're going to talk in general about annuities, fact or fiction. And the reason why is, the internet's great. There's so much information at our fingertips. But remember, there's a quote by Abraham Lincoln. And the quote goes, "Everything you read on the internet is true." Now, I hope it may take a little while to get that joke, right? But you got to be careful. There's so many opinions out there, and most people give you their opinions and they know nothing about what they're talking about. This is what I do for 30 years. So I'm going to give you all this information about the truth about annuities, despite what you may have read or what you may have heard. So as we go over this, who are we? Strategies for Retirement. Look, we have educated thousands of people on webinars, on live events, on how to protect their income and assets due to financial risk. We have helped people create lifetime income streams to make sure that they'll have the income for the rest of their lives. And we certainly help people reach their financial goals and their retirement dreams. We have a great Facebook page. If you're not liking us on Facebook and you're on Facebook, go to Facebook, give us a like, follow us. We put out a lot of material out there, and we have a phenomenal YouTube channel called Green Line Money TV. Great material there. We're constantly adding material, and we're also on Instagram. So definitely follow us on these things and look us up. Also, if you haven't listened to my radio show, Safe Money and Income Radio Show, I'm the host of this radio show. We air it every Saturday and Sunday. It's on all these different stations. And if you're not in the area where you get that station, you can always listen to our podcast, which you can find on our website. And the website is strategies4retirement.com. A lot of our emails have a website on it, and you can find the podcast on that. We put on every episode podcast as well as on the radio, on AM radio, talk radio, all Saturday and Sunday. You pretty much can't miss us. I get a lot of calls, people driving through Connecticut, and they go, I was driving through Connecticut, I heard your radio show. Great radio show. The other thing is, when I go over the information today, you're going to have an opportunity to make a phone appointment with me. If I say something that you really like and sparks interest and you want to learn more, we're going to set up a phone consultation. There's no cost, there's no obligation. And I'm going to help you and go over a little more detail what you might learn in today's webinar. But the way to make this is you got to be familiar with that red tab with the 3 little dots. Because as you click that, there's going to be a place that's going to show you how to make that appointment. And you're going to fill out a form. But when you click that to fill out the form, you're not going to leave the webinar. All it's going to ask you is your name, the best phone number to reach. So Sharon, my assistant, can make an appointment with you. Sharon can make an appointment up for us on our schedule, right? So all you need to do is click on that. It's not up yet. I'm going to put it up in a little bit. But I want you to realize when you click on it, that's what it looks like. It's just a simple form. You will not leave the webinar, right? And a little bit about myself. I know, depending if you're familiar with Strategies for Retirement or not, I've been in this business for 30 years. In the middle is a picture of me carrying the torch for the Olympics in 2002, Salt Lake City Olympics. That was a very highlight of my career. I was carrying the torch in Hartford, Connecticut. But I will tell you, my business and the way I look at this really changed in 2008. Now, I'm in the business. I have many different licenses. And I've been in the business 30 years. But in 2008, I got burned by the stock market. I lost a lot of money in the market. And, everybody said, oh, I have a diversified portfolio. It lost money, enough to make me feel uncomfortable. And that's what I heard from clients, too. A lot of people I knew lost money. And it took years to make that money back. Now I'm in my 50s right now. I can't afford to lose anymore. If you're in your 50s, 60s, and 70s, and you can't afford another 2008, then listen up, because you're going to really want to take some good notes about today's webinar. But with that said, I decided to really look for safe money choices. After that 2008 issue, I was like, I hate losing money. A lot of my clients hated losing money. And I looked for safe money solutions and approaches for my clients so that they can grow their money without the risk of losing it in the market. They can get a reasonable rate of return. They can have peace of mind knowing their money's protected. It'll grow, and they won't lose it because of something they had no control over in the market. And that's the premise of what we do. We help our clients protect their assets and income due to potential risk to their, due to the potential risk they'll face today or in the future. And, we use certain financial products that are available. And what I would tell you is there's an old saying, you don't know what you don't know. Today, you're going to learn things that you may have not known. So keep an open mind as we go over this, because you don't know what you don't know. You might be in a different stage in life now than you were when you're much younger. And maybe you can't afford to lose this money. You can't afford to have it at risk. Make sense? So we're going to talk about annuities. What is an annuity? how do annuities work? I'm going to clear up some of the confusion that you might hear out there about annuities. So one of the things that's interesting to realize is where annuities came from. How long have they been around? Where did they start? Why and where were they used? How did they work? Annuities actually have a really long, rich history, which started during the Roman Empire, believe it or not, 2,000 years ago. They are one of the oldest financial tools that were ever created and a very successful financial tool. So they've been around probably if you add all of us on this webinar, I tell you, and add all our ages, annuities have been around longer than that, right? Now they've changed over the years, just like everything else has changed, right? They didn't have cars back then either, right? So they have changed, but definitely many attribute the annuity being a financial bridge to development of our modern world. Now, these four people have one thing in common. They all use annuities in their financial planning. Beethoven, Benjamin Franklin, Babe Ruth, Shaquille O'Neal, all different generations, all use annuities in their financial planning. Now, there were different products they used, and annuities have changed over the years, but they all used annuities for their planning. These are not new. Annuities have been around for a long time. And annuities are actually offered through insurance companies, where you can go to a bank and open up a savings account or a money market or a CD, and a bank has many different financial options. Well, insurance companies have many different financial options: life insurance, long-term care, disability, right? Health insurance, whatever insurance is out there, automobile, homeowners insurance. But annuities are exclusively offered through insurance companies because they are an insurance product. And the original annuities, which I'll go over, were more of what we call an income annuity or a pension annuity, because there's actually four kinds of annuities on the market today. And I think this is really important because when someone says the word annuity, what does that really mean? It doesn't mean much without the word in front of it. So an annuity by itself, you can think of it like a bank account or money market, right? The annuity itself is just a word. The word before the annuity will describe what this actual financial product will do. So when you hear people say annuities are good or annuities are bad or whatever, the reality is, what kind of annuity are we talking about? Because that will really determine whether it's good or bad for you. Because there's different places that these products fit based on your problems, based on your solutions and your goals of what you're trying to accomplish, right? So going back to this, there are generally four kinds of annuities on the market. So let's go over these four because I think it's really important to understand these four and where they fit and where they don't fit. So the first kind of annuity is the oldest kind of an annuity. This is how it started during the Roman Empire. They were called immediate or income annuities. And actually, they were the exact opposite of life insurance. So while life insurance, you die, there's a death benefit paid out to your beneficiaries. The pure old kind of an income annuity was the exact opposite. It was called longevity insurance. And it was used to give someone income for the rest of their life to cover the risk of living too long. While life insurance is covering the risk of dying early, the original annuity was actually covering the risk of longevity, living too long, and would pay out an income. So the very first kind of annuity that was created, the Ben Franklins, right, used, Beethoven and Ben Franklin used, were more old school annuities where they were income or immediate annuities. They're designed to give you income as pensions, guaranteed income. And yes, one of the challenges of these is when you give the insurance company a certain amount of money, they give you income. But in the old school annuities, the money was gone. So you ever hear Aunt Sally had this annuity and she died and there was no money left? It's this kind of annuity they're talking about. Now, interestingly enough, many of you may have this kind of annuity and don't even know it. Yeah, I love when I get on the phone with someone. They go, annuities, I don't want an annuity. And I'm like, do you have Social Security? And they go, yes. I said, then you have an annuity. If you are collecting Social Security right now, you have an immediate annuity. You paid money into it in the government all those years, and now the government's giving you an income for the rest of your life. But when you die, the income stops, right? Well, another one is a pension. If you've ever retired from a company, or if you've known someone who was retiring and they got this big, thick book in the mail that said you have an option. You can take a lump sum of money, or you could take an income for the rest of your life. And there's usually certain options: income for the rest of my life, income for the rest of my wife and my life, right? But there's an option: take the money or take the income. And a lot of people retiring have those pension options. Those are annuities. When you take the income, you're taking an immediate annuity. You're giving up the lump sum for income. So again, these were the first kind of annuities created. They were called income or immediate annuities. There is a use for them, but in this day and age, they're not used as much as they used years and years ago. Why? Because annuities, insurance companies figured out one of the things people didn't like is they didn't want to give up their lump sum. So insurance companies went back to the drawing board and created products where you don't have to give up your lump sum, but you can still get some income. And those are some different kinds of annuities on the market today. So we don't use these income immediate annuities very, very often. There's a time and a place for them, but they're more old school, or Social Security or pension is a good example of them. Now let's go on to the fixed annuity. Now this is a very, very simple annuity. I call it a CD alternative because it's very similar to a CD. Now I think back about my grandparents. So my grandparents were CD shoppers. They did not like risk. They worked hard for their money. They saw people in the Great Depression lose their money. And how many of you remember when CD rates were paying like over 10% or more, right? Raise your hand. Put in the chat. Do you guys remember when CD rates were paying 10% or more? I'm going to just quickly take a peek at that chat. I see we got Bonnie on here, Frank on, Joyce, David. Yeah, put in the chat. You remember when CD rates were paying more than 10%? Right? My grandparents, that's what they lived on. They shopped around CDs. They didn't want to risk their principal. And basically they lived off the interest of the money. Well, fast forward to today, what are the banks paying on CDs, right? 1% if we're lucky. It's pathetic. They're earning more dust than interest. But what a fixed annuity is very similar to a CD. It has a guaranteed rate of interest that it will pay for a certain length of time. So I'll give you an example. One of the more popular fixed annuities we offer is a 3-year account. Pays a little over 2% every year for 3 years. Now, certainly we'd all like to get better than 2%. But that's a lot better than the CDs. So if you have like a CD renewing right now and they're offering you less than 1%, well, we could offer you more than 2% on a 3-year guarantee, and then 3 years later, take it out, move it, do whatever you want. But that's what a fixed annuity does. It gives you usually a much better rate than a CD. It's a guaranteed interest rate for a certain length of time, usually 3, 4, 5 years, that kind of thing. And you could pull out money during that time. Many of these companies allow you to pull out up to 10% out of the account, and the money grows tax deferred. So fixed annuities have their time and have their place. They usually always pay much more than a CD. That's why we call them a CD alternative. And they're very, very flexible, more flexible than a CD. So if you're someone who loves CDs, you know what? It may be fixed annuities may be a good option for you because it's going to give you a higher rate of return. And just to put this in perspective, the banks are paying like 1% right now. I want you to think about this. If you earn 1% on your money, do you know how long it would take to double your money? According to rule of 72, it takes 72 years to double your money at 1%. If you earn 2%, it would take you half that time, 36 years. Now, 36 is a long time to double your money as well. I like more like 3, 4, 5, 6%, right? But think about that. Just earning an extra 1% cuts that in half. And that's why fixed annuities work so well. And we have a lot of great options on fixed annuities. So if you're a CD shopper and you're shopping around, give me a call, set up that phone call, because I can help you and we can show you the best rates that fixed annuities are paying right now. I can even run a report for you. Now, the next kind of annuity is called a variable annuity. And you see that old brick cell phone. Do you guys remember that old brick cell phone, right? Well, what happened was insurance companies continued to improve their products. And they had the immediate annuities, income annuities, and they had the fixed annuities. I said, well, what if instead of giving a guaranteed rate, we actually wrap an annuity around a wrapper of mutual funds. So we can actually put people's money in mutual funds. They have the potential to get more gains on their money, but still it's an annuity that grows tax deferred, and we'll add a few income benefits and make it sound really nice. Now, I'm going to flat out tell you I am not a fan of variable annuities. In fact, generally when you hear someone talk about annuities being bad, they are talking about variable annuities. Variable annuities do have risk. They do have fees. A lot of the financial companies sell variable annuities. This is out of all the 4 kinds of annuities, this is one kind of annuity I don't carry, I don't want to carry, and I'm not a fan of. Now, if you're in one, it pays to do a review, because just like cell phones have changed, you're holding a very old cell phone, and there's better options on the table today. So if you have a variable annuity, I would say set up a review and let me review it. Let's go over it. Let's call the company together. In fact, oftentimes when someone has a variable annuity, they don't even understand what they have. These things can be complicated. And we'll call up the insurance company together and we'll ask them, what are the risks? What are the fees? What is this? What is this? And if we can improve it, we're going to improve it. As a fiduciary, I'm always looking out for the best interest of a client. So if I can improve it and make it better, I will. If I can't, I won't. But, I've talked about setting up a phone appointment with me. So let me put this up there right now. So if you click that red tab with the 3 dots, it's going to open up a new slide. And I'm just going to put this up here. This is very easy. All you got to do is click that link, request appointment, and get your YouTube link. And you just click that link, and it'll take you to a different page. You won't leave the webinar. You'll be able to fill out that sheet, and we'll be able to set up a phone appointment. But I'm throwing little tidbits out here. And if anything that I mentioned sparks you to want to set up an appointment, just click that link. I'll keep it up for the remainder of the webinar. Okay, so we left with variable annuities, not a fan. There's risk and fees. But then there was an annuity that came out about 25 years ago. There really was a dramatic change. In fact, it was a game changer for people, for consumers. Because what it allowed consumers to do was cut out any of the risk of losing money in the market, but get some upside potential. So basically what it allowed consumers to do was get rid of market risk. They're still getting growth when the market grows, but when the market goes down, they're not losing anything. And these type of accounts have been around for 25 years. Over those years, they've improved a great deal. They're one of the most popular kinds of annuities today. They're one of the most popular kinds of financial accounts today. And what they're called are fixed indexed annuities. So they actually are a subset of the fixed annuity that I went over before, where a fixed annuity pays a guaranteed interest rate like 2%, for example. What a fixed index annuity or equity index annuity does still gives you the safety of your principal. They're literally, most of them have 0 fees in them. But what they're doing is they're giving you upside market potential. When the market goes up, you get gains. But when the market goes down, you don't lose any money. Now, many of them have some optional things you can add on to that that's not necessary. So fixed and equity index annuities alone don't have fees, but when you start adding on an option, if you want income or death benefit things, there's all these bonuses you can add on to it. And that depends on your situation, whether that's worth it. But in and of itself, the fixed index annuities have become very, very popular. Now, I do a lot of educational seminars about this, and it wasn't about the fixed index annuities per se. It was about trying to find a solution. After 2008, I was like, where can I find safe money solutions? Well, banks don't pay anything. Market still has risk. And I started taking a look at these fixed index annuities, which I actually call green lines. And I started looking at these and said, these are pretty good. When the market goes up, you get gains. Market goes down, you don't lose any money. There's no risk, no fees. You keep the gains when you lock it in. These are pretty good. The only trade-off is some time. I got to commit some time to it. But all in all, if I'm looking for safety with a reasonable rate of return, these are a perfect fit. And I started using them a lot for clients because they are a good fit for some people who are risk adverse, who don't want to lose money in the market anymore. So as you can see, there are 4 kinds of annuities on the market, which brings me to this. Common misconceptions of annuities. Now that you know the 4 different kinds, what are the misconceptions? Well, annuities have high fees. Remember, there are 4 kinds of annuities, but only one of them had fees, which is a variable annuity. 3 of the annuities I showed you have no risk and no fees. So that is a misconception. Annuities lock up my money. Well, it is true with annuities, you do have to make somewhat of a time commitment. It's called a surrender period. It could be as little short as 3 years, as long as 10 years or longer. But during that time period, you could pull money out. Most companies allow you to pull 10% out of your account every year during that time period, the surrender period. If you die, there's no surrender period. It goes to your family or your beneficiaries. A lot of companies, if you have an emergency like nursing home or home care or terminal illness, they'll waive the surrender period, let you pull it all out. And the fact is you have access to 100% of your money anytime you want. If you to pull out more than 10%, you pay a penalty. But the penalty is tiny compared to what you might have lost in the market. So annuities, despite popularity, do not lock up your money at all. Now, another one is lump sum trade-off. Talking to someone on the phone last week, he goes, well, I give the annuity company my money. My money's gone if I die. Remember, we went over this. There's 4 kinds of annuities. Depends what kind of annuity we're talking about. There's only one kind of annuity, the immediate income annuity, that does that. The other kinds of annuities don't do that. You still have your money. You have your cake and you can eat it too, right? Annuities are complicated. Again, which kind of annuity are we talking about? Income annuities are very easy to understand. Fixed annuities like CDs, simple to understand. Fixed index annuities is simple to understand. Market goes up, you get gains. Market goes down, you stay where you are. The only one that's very complicated are variable annuities. And for the same reason a variable annuity is complicated is probably the same reason your brokerage accounts are complicated. You know, look, when you get a statement in the mail with 30 pages from your brokerage account, right, do you really read it? No, you read 1 or 2 pages, throw it out because it's complicated. You ever get those thick white books from those investment companies? They're called prospectus, right? Do you read the prospectus? Most people just throw it out, recycle it. Talk about complicated. Those are much more complicated than any account that I'm going to recommend to a client on a fixed index annuity. So annuities are not complicated except for a variable annuity, which again, I don't like anyhow, but the other annuities are very simple. And then the question is, how safe is my money? What happens if the insurance company goes under? I think there's a few things to consider. First of all, if your money's in the market right now, it's not protected and insured at all. Now, if your money's in the bank, it's insured by FDIC. Or the strength of the bank, right? And you have the FDIC to back it up. Well, annuities are backed by the strength of the underlying insurance company. If you pick a strong, safe, reliable company that's been around and has really, long track record, that money really is just as safe as a bank. Annuities and insurance companies have to have a thing called cash reserves. For every dollar they take in, they have to have more than that in their cash reserves to cover future liabilities. So when you look at the cash reserves of an insurance company, the ratings of the insurance company, they're actually stronger than most banks. In fact, I have a great pamphlet, a PDF called Intro to Annuities. And this is where it talks about the Roman Empire and Babe Ruth. If you'd like a copy of this, please just put in the chat to send you a copy. We can email you a copy of this. All you need to do is my team is on the chat right now. Put in the chat you want a copy of this. We'll send it to you. But it talks about the strength of insurance companies. It talks about during the Great Depression, this is where people put their money. This is where Babe Ruth put his money during the Great Depression because annuity companies were strong. It was the banks that were failing. Oh, one last thing. Although it's not FDIC, insurance companies do have and annuities do have a level of protection similar to FDIC. When you make that appointment, I can tell you a little more about that. But there is protection, God forbid a company did go under, which very rarely ever happens. So make that phone appointment with me. We can go over your personal situation, and we could go discuss a little bit more on that. But annuities are extremely safe. Your money is extremely safe in an annuity as far as the strength of the insurance company. As far as market risk in a fixed or fixed index annuity, your money is very, very safe. In a variable annuity, not so much, which is why I don't cover variable annuities. They don't fit my safe money approach. So where do annuities fit into your financial picture, or do they fit in? And again, you don't know what you don't know. Look, it's just like when we're saving money for kids, to go to college, we had goals there. When we were younger, we had goals. If you're in retirement or you're pre-retirement, where you're going to retire in the near future, annuities can be a really, really helpful part of your retirement planning. So what you first need to do is really identify some goals. And let me go over this. You need to identify how you feel about market risk. To the left is safety, to the right is risk. Red line money is risk money. Green line money is safe money. The question is, what do you want to lose? None of your money, some of your money, of all of your money. If you're willing to lose all of your money, then stocks, bonds, and mutual funds are the place to be. But if you're sick and tired of your money at the mercy of the market going up and down, then green line money, fixed or fixed index annuities can be very helpful. Second thing is inflation risk. Here's a challenge. If you have money sitting cash in the bank, it's earning more dust than interest, will it keep rate with the cost of inflation? Because if it doesn't, you're losing money. Well, a lot of the fixed index annuities earn better than the bank and just as safe as the bank because it protects your principal, right? So if that's important, then might be something we want to look at. And then longevity. Do you have an income plan that's guaranteed for the rest of your life versus an if-come plan? Most people have an if-come plan. They're not sure their money will last a lifetime. They have to rely on certain things that if this happens, if that happens. When you look at longevity right now, I like planning for guaranteed. So do you have guaranteed lifetime income that will last for the rest of your life? Or do you want to leave money to your beneficiaries? And again, that's called longevity risk. When you look at longevity risk, inflation risk, and market risk, then the right annuity may be a good fit. This is why we use these fixed annuities all the time. They protect the principal. They have very low or no fees. They give you market upside participation with no downside risk. And there's all kinds of options we can add on. Now, real quick, if you see this green line, and if you've been to my other webinars, you know I call this green line, this is what I call a fixed index annuity. And I'm just going to really cover this quickly. As you can see in 2008, when the market crashed, the green line didn't go down. Those are fixed index annuities. When the market started going up, the green line went up. So it gives you safety with a reasonable rate of return. And by the way, every year here, the return was locked and became part of the principal. If you'd like to learn more and talk more about this, then please set up that phone appointment with me. Because what these accounts will do is protect your principal, give you a reasonable rate of return. There are no fees, or sometimes a rider we can add, lower no fees. We could customize these options to give you income if you want, and they're simple and easy to understand. So with that said, if you'd like to learn more, you'd like to talk and take this conversation, right now I'm talking to you. I'd rather talk with you. So instead of talking to you, if you'd rather talk with me, set up this phone appointment by clicking that link, fill that form out. We'll actually give you access to our YouTube page as well on that form, where you can look at all the videos we've done on our YouTube page. We'll certainly send you out this introduction to annuities as well. And we'll make a phone appointment. We'll talk on the phone. We'll find out your concerns about market risk, inflation risk, and longevity risk. And we'll see how we can help you. Here's my phone number. Here's my email. With that said, I want to thank you for joining me at today's webinar about annuities, fact or fiction. I really hope I was able to help educate you about some financial tools that we use for our clients, and we use personally as well, that really help secure our financial future and our retirement dreams. Please set up that appointment with me. I am Mike Lehrhaupt, Strategies for Retirement. Have a great day. See you soon.